Financial earthquake shaking every American household. Record surge in credit card debt to $1.21 trillion.
Discover causes, impacts, and how to protect yourself now.
All right, let's cut straight to it. There's a financial earthquake rumbling right now, one that's shaking nearly every American household, and the figures are truly astonishing. We're talking about a record-shattering surge in credit card debt across the U.S. Today, on the Deep Dive, our mission is to peel back the layers. We'll explore the what, these unprecedented debt levels, the why, the perfect storm of economic forces driving it, and crucially, this so what this means for a potential consumer recession heading into 2025. And most importantly, what you could do right now to navigate these turbulent financial waters.
What's truly eye-opening here isn't just the numbers themselves, but the sheer speed at which these trends have developed. You see, while the broader economy has shown remarkable resilience in many sectors, this particular area of consumer debt is, well, it's flashing a bright yellow light for millions of families. To bring you this picture, we've dug deep into everything from Federal Reserve reports and Consumer Protection Bureau data to leading economic forecasts and financial news analyses. It's a pretty comprehensive look at a very concerning trend.
And when we say record-shattering, we really mean it. The bottom line is staggering. Total U.S. credit card balances soared past the $1 trillion mark in 2023. And by the end of 2024, they actually rocketed to an astounding $1.21 trillion.
1.2 trillion, wow.
Yeah, think about that for a second. That's not just a little bump. It's a jaw-dropping 20% jump from $986 billion in just 2 years. We're talking about unprecedented quarter-over-quarter increases, like the nearly $50 billion rise in Q4 2023, and then another $45 billion in Q4 2024. It just keeps climbing.
Right, and it raises a vital question. How does this truly compare historically? These aren't just big numbers. They are the highest on record since the New York Fed started tracking this data back in 1999. We're well beyond the pre-pandemic peak, which was around $930 billion. And it's not only the national total that's up. The average cardholder's balance has also climbed significantly, hitting about $7,300 in early 2025.
$7,300.
Yeah, that's up roughly 6% from just a year prior, which strongly suggests that everyday Americans are leaning pretty heavily on these credit lines, maybe just make ends meet.
Here's where it gets really interesting and, frankly, a bit alarming. As of mid-2024, credit card balances were increasing at nearly a 12% annual rate. Now, pause and think about that. Debt is rising far faster than wage growth or inflation. That kind of trajectory is simply unsustainable long-term.
Definitely unsustainable.
And it's not just existing cardholders deepening their debt. We saw about 17 million new credit cards opened in Q4 2024 alone. That's more than 3 times the number of new accounts opened just a year earlier. Now, while overall household debt, including mortgages and student loans, has grown more slowly, it's this spike in revolving credit that's the big red flag. It points directly to significant, widespread financial strain for many families.
And when we connect this to the broader economic picture with record high balances, it's almost inevitable that we'd start seeing cracks form. Cracks in the form of rising delinquencies and defaults. After an unusual lull during the early pandemic, the share of U.S. consumers falling 30-plus days behind on their credit card debt has been climbing steadily since 2021.
Okay, so people are starting to miss payments more often.
Exactly. By Q1 2025, 3.05% of all credit card balances were delinquent. This rate actually hit 3.24% in mid-2024, which was the highest since late 2011, and importantly, it's now above pre-pandemic levels. Put simply, a growing chunk of credit card debt just isn't being paid on time.
So what's the real human cost behind these numbers? More and more borrowers are falling seriously behind. By Q4 2024, a staggering 11.35% of credit card balances were 90 days or more delinquent.
11%, 90 days late.
Yeah, that means over 1 in 9 credit card dollars is owed by someone who hasn't made a payment in at least 3 months. This isn't an isolated problem either. All age groups are seeing upticks in missed payments, but it's borrowers in their 30s and 40s who are experiencing the fastest rise. And here's a surprising twist. Even some higher-income Americans, those earning $150,000 or more, are struggling, with their delinquencies up roughly 20% in the past 2 years.
That is surprising. Suggests it's broader than just lower-income groups.
Right. It suggests the debt burden is much broader than we might assume.
And, of course, the ultimate consequence of these missed payments is a rise in default rates, or what banks call charge-offs. The credit card charge-off rate reached around 4.7% in late 2024, which is also the highest it's been since 2011. Now, while lenders and regulators might characterize this as a normalization back to, say, pre-2010 levels after a period of artificially low rates, let's be clear, credit card delinquencies have nearly doubled since early 2022.
Doubled? That doesn't sound like just normalization.
Well, it's a bit of both, maybe. Looking ahead, forecasts from TransUnion project serious delinquency to reach about 2.76% in 2025, which is a continued, albeit modest, increase. Bank economists largely concur, predicting overall consumer loan delinquency to be just under 3% in 2025. This points to ongoing stress, but it's important to differentiate. This isn't yet the explosion we saw during the Great Recession, when card delinquencies topped 6% and charge-offs exceeded 10%. So it's serious, definitely serious, but not catastrophic yet, unless the broader economy takes a severe turn.
So with that stark picture of rising debt and defaults, the obvious next question is, what's actually fueling this fire? What's driving this credit card debt boom? It truly feels like a perfect storm of economic and policy factors that have converged since maybe 2021.
Exactly. It's a multifaceted problem. Let's break down the major culprits, because each one plays a critical role. First up, stubborn inflation and the relentless rising cost of living. Throughout 2022 and 2023, inflation simply outpaced wage growth for many.
Right. Everything just got more expensive.
Forcing households to turn to credit cards for what used to be covered by their regular income, things like gas, groceries, utilities. Over 80% of Americans report feeling the squeeze of rising prices, and a significant portion openly admit to putting these daily necessities on credit. That means people are borrowing just to cover the basics.
And I imagine with those rising prices, people are then hitting their cards just to get by. But then there's the cost of carrying that debt, which has also been skyrocketing, right?
Precisely. That brings us to our second major factor, the soaring interest rates, or APRs, on credit cards. The Federal Reserve's rapid rate hikes, designed to cool inflation, had a direct impact here. The average credit card APR jumped from about 14.5% in late 2021 to above 21% by 2024, an all-time high.
21% average.
Yeah, and get this. Large banks were charging a median of approximately 28% APR for customers with good credit. 28%. These high rates create a vicious cycle. Your finance charges eat up more and more of your payments, sometimes causing your balance to grow even if you're not making new purchases, just due to the interest piling up.
That's almost loan shark territory for someone just trying to buy groceries or cover an unexpected bill. It really puts the squeeze on, doesn't it?
Right.
What else contributed to this perfect storm?
Well, beyond the immediate financial pinch and the cost of debt, we also saw a major shift in how people manage their money after the pandemic. During 2020-2021, stimulus payments and reduced spending meant many built up a cushion of savings. But by 2022 and 2023, those post-pandemic savings were largely depleted, especially for lower income tiers.
So the buffer was gone.
Pretty much. Yet, consumer spending remains surprisingly robust, partly due to pent-up demand and what some called revenge spending. The personal saving rate plummeted to around 3%, one of the lowest since the Great Recession, indicating that much of this continued consumption is now debt-financed. And adding another layer of pressure, student loan payments also resumed in late 2023, pushing some to lean even harder on credit cards.
So people ran through their reserves but kept spending, often out of necessity, which means they turned to credit. And speaking of credit, I heard that some of this debt boom can be traced back to who was actually getting credit in the first place.
Absolutely. Our fourth factor is looser credit availability, or what we sometimes call relaxed lending standards. In 2021 and 2022, credit card issuers expanded access pretty aggressively. More subprime and new-to-credit consumers were approved, often with higher credit lines.
Subprime meaning riskier borrowers.
Essentially, yes. People with less established credit histories or lower credit scores who statistically are more likely to struggle with repayment. This expanded access, while seemingly good on the surface, giving more people access to credit, directly contributes to the rising delinquency rates we're seeing now. Although credit availability has begun tightening more recently, the impact of those earlier decisions is still very much with us.
And beyond these big four, were there any other lingering pressures squeezing household budgets?
Yeah, there were several other pressures at play, things like stagnant real wages, surging housing and auto costs that eat up more of people's income, and the end of crucial federal aid programs such as the expanded child tax credits. Even the rise of buy now, pay later (BNPL) services, while convenient, can sometimes add to overextension if not managed carefully. It all adds up. All these factors combined created an environment where families are increasingly relying on revolving credit, even as it becomes significantly more expensive.
So when you put it all together, high inflation making everything more expensive, sky-high interest rates making debt more punishing, and savings accounts running dry, it creates this rapid and, unfortunately, self-reinforcing increase in borrowing. It truly is a vicious cycle. The more you lean on credit, the more interest you owe at today's record rates, which can then necessitate even more borrowing just to keep your head above water. It's a tough spot for a lot of people.
And this brings us to a crucial question that's on everyone's mind. Is this credit card debt explosion inevitably leading to a 2025 consumer recession? Opinions are actually quite divided among economists, which makes it a really interesting debate to follow.
On one side, there are strong arguments for a potential downturn. Evidence suggests that the lowest-income Americans were already in what felt like a recession-like scenario by late 2022, simply relying on debt to survive. There's real concern about a trickle-up effect spreading financial pain. If higher-income groups also pull back, say, due to depleted savings or a market dip, overall consumption could drop markedly.
Right, and we're seeing some of those early signs.
Exactly. And we're already seeing those signs of stress, with delinquencies rising even for those $150 K plus earners. That personal saving rate of 3% isn't just an economic indicator. It means most families have very little buffer for unexpected emergencies. That flat tire, that sudden medical bill, pushing them straight back onto high-interest credit. Bloomberg's chief U.S. economist, Anna Wong, for example, she cites this surge in debt and delinquencies as a worrying sign, placing around 70% odds on a recession by 2024 or 2025.
70% is pretty high. But on the flip side, the soft landing perspective offers a more optimistic outlook. The key factor here is a strong labor market. With unemployment hovering around 3.54% and solid wage growth, many consumers have remained employed and, for now, are largely able to service their debts.
So jobs are the key support right now.
They're a huge part of it. Plus, many households, particularly upper-income ones, still possess significant excess wealth from home equity and stock gains, providing a different kind of buffer. Deloitte economists in late 2024 argued that rising card debt and dwindling savings are not enough to reverse overall spending gains, provided employment remains robust. Another factor is that banks are tightening credit-raising score requirements, lowering limits which could naturally curb future debt growth. And monetary policy is always a wild card. The Fed, seeing some cooling inflation, had reportedly trimmed rates by about 1 percentage point by early 2025. This could eventually ease pressure on credit card APRs, potentially prolonging consumers' ability to spend without crashing.
So what's the consensus among forecasters at the start of 2025? Sounds like a toss-up.
It's pretty much even odds, or slightly worse, on a recession. JP Morgan's models, for example, put around a 40–50% probability of recession by late 2024. The period of greatest vulnerability might even stretch into late 2025 if consumers finally run out of steam by then. Ultimately, the key metric to watch, the one that tells the real story, is consumer spending. If Americans pull back sharply, especially on discretionary purchases, that would be the clearest signal for a broader economic downturn.
Okay, let's switch gears and focus on something empowering. If you're out there feeling the squeeze from these rising credit card bills, know this. There are concrete, actionable strategies you can use to manage and mitigate financial stress right now. You are absolutely not powerless in this situation.
That's right. The first step, and it sounds basic, but it's foundational, is to create and actually stick to a budget. Track all your income and expenses, line by line, to truly see where every dollar is going. Identify areas where you can cut back, even temporarily, maybe dining out less, or reviewing subscriptions. The goal is to stop relying on credit for basics and direct any freed up funds towards paying down existing debt or building a small emergency cushion.
Budgeting can feel like a chore, but it's your financial roadmap, right?
Okay.
Once you have that, how do you tackle the debt itself? Which card do you pay first?
Exactly. Next, you need to pay down debt strategically. If you have multiple card balances, consider either the debt avalanche or debt snowball method. With the debt avalanche, you focus your extra payments on the card with the highest interest rate first. This saves you the most money over time, mathematically.
Okay, highest interest rate first. Makes sense.
The debt snowball, on the other hand, focuses on paying off the smallest balance first, giving you a quick psychological win and building momentum. Some people find that more motivating. Whichever method motivates you, the key is to pay more than the minimum whenever possible, and try to pay early to reduce the amount of interest that accrues. Even paying a few days early can help a tiny bit.
And sometimes you might need a bigger hammer to get out from under those crushing interest rates, right?
Yeah.
Are there options for lower interest?
Yes, you might consider lower interest options, but with caution. A 0% introductory APR balance transfer card, for instance, can give you maybe 12 to 18 months of no interest. This is a golden opportunity to aggressively pay down principal. Just be acutely aware of any transfer fees, usually 3–5%, and ensure you can pay off the balance before that introductory rate jumps significantly, often to 25% or more.
Right, got to watch out for that cliff at the end.
Definitely. Another option, if you have decent credit, is a debt consolidation or personal loan with a lower fixed rate. But a crucial warning. Avoid turning unsecured debt, like credit cards, into secured loans, like tapping into your home equity unless you are absolutely confident in your repayment ability as you risk your home. Always compare total costs, and critically, avoid running up new balances on your old cards. That defeats the purpose.
What if someone is already really struggling, feeling overwhelmed, and maybe falling behind?
Crucially, communicate with your creditors and seek help early. Don't wait until you're completely overwhelmed or getting collection calls. Many lenders offer hardship programs if you explain your situation honestly. These can include things like lower interest rates, waived fees, or adjusted payment plans. You have to ask. Also, reach out to reputable nonprofit credit counseling services like those affiliated with the National Foundation for Credit Counseling, NFCC. They can help create a debt management plan, or DMP.
A DMP, what's that involve?
It involves them negotiating lower rates with your card companies and setting up a single, more manageable monthly payment, which they distribute for you. It can be really helpful. Just be very careful. Avoid those for-profit debt settlement companies you hear advertised. They often charge exorbitant fees and can actually damage your credit score significantly. Stick with accredited nonprofits.
Great advice. Talk to someone who can help and avoid those risky quick fixes. Any final advice to weather this storm?
Finally, build an emergency fund, even a small one, and commit to using credit wisely going forward. Even a buffer of $500 to $1,000 can be incredibly powerful. It can prevent you from automatically swiping a card for unexpected expenses, helping to break that debt cycle. Limit taking on new debt, actively save up for big purchases, and make sure you track any buy now, pay later services you use within your budget. They can add up fast, and always pay on time. Those late fees now capped at $8 by the CFPB for many large issuers, which helps a bit, and penalty interest rates will only compound your challenges. Proactive steps are your best defense.
So, what does all of this mean for you? We've seen that America's credit card debt has exploded, driven by that perfect storm of inflation, high interest rates, and depleted savings. While experts debate whether a recession is an inevitable outcome, what's undeniably clear is that many households are feeling the strain. But the good news, as we've discussed, is that you are not helpless. There are proactive steps you can take right now to regain control of your financial situation.
Yeah, and this situation raises an important question that extends beyond individual actions. We've discussed robust personal strategies, but given the sheer scale and systemic nature of this credit card debt surge, is the current economic structure truly robust enough to allow a genuine soft landing for everyone? Or will we eventually need broader, perhaps systemic solutions to truly alleviate this kind of widespread consumer financial stress? Something to think about.
The road to financial stability may be challenging, absolutely. But with the insights and strategies we've discussed today, you're now much better equipped to navigate these turbulent